Well, hi guys, here is Ludo from Horizon Trading Team. Today I just would like to introduce you a little bit of fundamentals and basics about Forex market. Well, just a little bit of an introduction. We are a team of professional traders that we like to spread and broadcast our strategies, analytics throughout our educational material on our YouTube channel and our social medias, Facebook, Instagram and Twitter. So if you like the content of this video, please do not hesitate to come visit us and subscribe, press the like button. So for now, let's move on to the presentation. Forex fundamentals, let's go.
Now I'm going to share concepts and main aspects of the biggest market in the world, the foreign exchange, better known as Forex. I would like to start off my presentation by giving you a little bit of an historical background and how the currency market has increasingly caught the attention of many global investors. Well, although it may seem very easy to invest in Forex nowadays by just logging into an account with a broker, deposit some money and start actively trading, it has not always been like this, as Forex industry has rapidly changed in the past 3 decades. Well, now I would like to drag your attention on a specific date, July 1944. This is a very important date in the economy history because it changed the whole system. But let's have a closer look. Well, in 1944, Bretton Woods Agreement. Before this system was set up, governments were tying their currency to a gold standard. Hence, a currency note issued by any government represented a real amount of gold held in a vault by that specific nation. When, however, in July 1944, delegates from 44 countries signed off the Bretton Woods Agreement, their main objectives were to reduce competitive devaluation, therefore currency wars, what we are actually experiencing nowadays among US and China mainly, but all around the world there are frictions in regards currencies and trades. Well, this reducing competitive devaluation was core and was very important, the decision to link a US dollar to a $35 an ounce of gold standards, while all the other currency worldwide were linked to the US dollar value, forming what's called nowadays a pegged or a fixed rate environment. Well, just to give you an example, if US governments at that time decided to link US dollar to, let's say, a gold standard of $500 an ounce, it means that a dollar value would have been 1/500th of an ounce of gold. Well, second in the agenda was to founding institutions to regulate trading environments worldwide. World Bank and International Monetary Funds were set up in that agreement at Bretton Woods in New Hampshire. Well, before they were recognized and like reconstruction and develop bank in order to set up funds to help out all those nations worldwide that were severely damaged by World War II. And that is how those kind of big institutions were founded. However, this agreement lasted only 27 years when in the early 70s the real economy outpaced the system, while dollar suffered from severe inflation, cutting its value by half. Well, let's imagine this. At that time in the US, unemployment rate was 6.1% and inflation was touching almost 6% at 5.84%. Well, finally, in August 1971, US government, led by Richard Nixon, took away the gold standard, creating the first fiat currency, replacing Bretton Woods system with de facto. Well, this is very much known as the Nixon Shot, and the true objectives were, first of all, taking away the gold standard, shifting to a free-floating regime in order to defeat the unemployment rate and the inflation rate. Well, this decision was driven by the many European nations asking to redeem their dollars reserved in their own government bank for gold. This had an enormous amount of impact on US dollar, which plunged against European currencies. Consequently, US Congress released a report suggesting a devaluation to protect the currency from foreign gougers. However, dollar dropped yet again, and Treasury Secretary was directed to suspend the US dollar convertibility with gold. Therefore, foreigner governments could no longer exchange their US dollar with gold. Well, there were other two measures taken by President Richard Nixon, and the first one, since the inflation level was skyrocketing, the action was to freeze all the wages and prices for 90 days. And this was the first time since World War II that this happened. Well, one more action was to impose a surcharge on import of 10%. And that was set up to safeguard American products, ensuring no disadvantage in trades. Well, as nowadays we all know, US dollar dominates financial markets, accounting together with euro for approximately 50% of all the currency exchange transactions in the world. Therefore, 1971 represents the beginning of a new forex trading era, bringing this market to be the largest and the most liquid in the world, with an average of daily trading volume exceeding 5 trillion US dollar. All the world combined stock markets don't even come close to this number. And what this does it mean to you? Well, this brings us to a new topic, and what we are going to describe here is how in the past 3 decades forex market has actually changed so much and why. Well, first of all, due to technology, forex became a much faster environment and is traded 24 hours 5 days a week. Well, starting off on 5 p.m. East time on Sydney time on a Sunday, closing at 4 p.m. East time on a Friday. Therefore, like due to the whole time zones around the world, Forex is a market that never shuts its gate. So 24 hours, 5 days a week. Well, the main financial centers include New York, Chicago, London, Tokyo, and Frankfurt for the Eurozone. It is by far the largest market in the world in terms of volume and is only followed by the credit market. Well, being highly liquid is a very important feature that's allowed traders to be able to enter and exit their position very quickly. Nevertheless, while trading, Forex investors should be aware as well of several components. First of all, dynamicity. Forex market is an extremely fast environment. This means that currency rates can move very fast, influenced by price action signals and fundamental factors. Therefore, going into forex trading, one needs to be aware of adopting serious risks and money management strategies in order to be much more effective and limiting losses. It is also known as a zero-sum game. While trading forex is not like investing in stock market, but is much known as zero-sum game. For instance, going into the equity market, buy some tech shares. They could both rise or decrease in value. Well, forex is different because currencies work in pairs. For instance, an investor decided euro will go up. He or she is doing it against another currency. Thus, in this specific marketplace, one currency will rise while the other one will fall, meaning an investor is buying the currency hoping it will appreciate to the other or selling the one that will depreciate. Well, there are as well many other factors that influence the forex market. One, and the first one I want to mention, is capital markets. Well, these are the most visible indicators of a country's economic health, where usually the healthier the economy, the stronger the currency. For example, a rapid sell-off from a country will show that nation is not economically stable. Subsequently, investor will think negatively of it, depreciating its currency. Well, moreover, many countries are sector-driven. This means that their currencies are strictly correlated with a certain resource. For instance, Canada, which is a commodity-based market. Canadian dollar is strictly linked to the price of Brent oil or any other metals. A swing in those will affect the Canadian currency. Finally, credit market is also connected to Forex, since also relies heavily on interest rate. So, a change in bond yield will have a major impact on currency prices. Like for instance, an increase in yield will favor a bullish market. Well, also, second part that I want to mention is balance of trades. Well, these are the most visible indicators of a country economic health, where usually when a country is in very high demand of good and service worldwide, will experience an appreciation to its currency. This is an effect driven by all the other countries converting their currency into the one that they state to purchase its goods and services. Let's say a product from the USA is in high demand globally. All the other countries must sell their currencies to buy dollars, then they will see their goods shipped. Thus, US will appreciate. Well, trade surpluses and trade deficits are also very strong indicator of a nation's competitive standing in international trade. Countries with a large trade deficit, for example, are usually importers, resulting in more of their currencies being sold to buy goods worldwide. Thus, they will see and they will experience a devaluation in their own currency. Another very important factor is geopolitical. Well, the political landscape of a nation plays a major role in the economic outlook for that country and consequently the perceived value of its own currency. Besides building up action, price action strategies based purely on price levels and patterns, Forex traders constantly look at economic calendars and news to gauge what could move currencies. Well, a geopolitical event which is having a great impact nowadays is the Brexit, especially lately. Well, let's see the GBP performances these days. Well, since the election of Boris Johnson, a strong believer in no deal Brexit, this election is driving the local currency to a 2-year low. Therefore, when investors observe instability from a nation's political environment, there are high chances that the currency of that country will depreciate. Well, now we see like what is forex and how the price of certain currencies can be impacted by different factors. I want to show you why you should consider to trade forex. And well, beside that now is a free floating market, well, there are like several factors that are very important to consider when trading Forex. Well, technology is a crucial factor that helped this financial sector to spread globally. With the introduction of internet in the 90s, Forex opened to retail investors, giving access to various trading platforms. This introduction increased the volume of this market by 5%, up to 250 billion of its daily turnover. Well, one of the main reasons why traders choose Forex to see potential earnings is volatility. Well, volatility is the indicator of how much the price is going up or down. Well, the more volatile is the market, the better it is for a trader. A, A trader is looking for long up and down moves rather than market fluctuating sideways. Volatility is great in Forex, and a trader can expect to regularly see prices oscillating 50 to 100 pips on major currency pairs such as Great British Pound US dollar, Euro, Great British Pound, Japanese Yen, and so on. Yet again, due to this enormous constant fluctuation, potential losses or gain can be very high. Thus, rigorous money management must be applied to avoid major damages and become a profitable trader. Well, to conclude, volatility is the main characteristic investors are looking at, and that is why it is one of the main features traders should take advantage of. Well, this volatility is given by certain players in the market, and now we're gonna see so. Well, the first ones are investment banks. Well, interbank market is the major responsible for the high volume registered daily in Forex. This is the place where banks exchange currency among each other, facilitating Forex transactions for customers and speculate for their trading desks. While client transactions, in this case, all the sides bank act as dealer, from the biggest bank to the smaller bank. Well, the bid and ask spread represent the profit for the institution, while on speculation, currencies are purely traded to profit from their price fluctuation, as well as to increase diversification on their portfolios. Because banking institutions are the biggest player in foreign exchange market, they are able to push up and down price of currencies, giving an extreme advantage and higher volatility to individual traders who are trying to gauge price movements. Well, beside in investment banks, we have central banks as well. Central banks representing their nation's government are crucial in Forex. They oversee monetary and fiscal policies, having massive influence on currency rates. A central bank is responsible for fixing the price level of its native currency on the market. In other words, they take care of the regime currency will float in the open market. Free floating, these are the currency which price floats on the open market based on principles of supply and demand relative to other currencies. Pegged, however, on the other hand, opposite to free floating currencies, are obviously not free floating in the open market. However, their government rather tie them up to the value of a stronger foreign currency. Peg currency are mostly seen in developing countries. For instance, CYN, Chinese yuan, is strictly linked to the value of the US dollar, therefore is pretty much following the movements. And because central banks manage interest rates in order to increase or decrease competitiveness of their nation, they also decide the interest rate increase or decrease. Well, in a dovish environment like the one we are seeing today, where everybody seems that printing is the solution, well, in these policies, will be lowering down interest rates. A central bank which applies the dovish conditions aim to give economic stimulus and guard against deflation. Usually, these policies intend to give economic stimulus and will weakening the currency value of that nation. Hawkish, on the other hand, are policies that lead to an increase in rates. A central bank that uses hawkish measures aim to reduce inflation. Typically, this kind of policies will reinforce the country currency value. Well, the third element I want to underline for our presentation is investment managers and hedge funds. They are the second force in Forex after investment banks and central banks, while investment managers buying currencies to speculate on foreign securities on behalf of the huge financial institution behind them, such as pension funds. However, on the other hand, hedge funds, they operate foreign exchange, execute trades in this specific market to speculate as part of their core strategy. Since hedge funds' main core value in the business should be absolute return, Therefore, speculation is their forte. Well, one more is corporations. Also, international corporations play a big role in Forex. Those firms operating globally, buying and selling goods and services, are involved in Forex transactions daily. Imagine an American company producing pipes that imports Japanese components and sell the finished product to China. After the sale is closed, the CYN, Chinese yuan, must be converted back to US dollar, while the American company must exchange US dollar into Japanese yen to repay for the component supply. Moreover, companies involved in international trade have an interest in Forex in order to hedge the risk associated with currency fluctuation, making several foreign transactions every day. Well, for instance, the same American company might buy Japanese yuan at a spot rate or enter a swap agreement to obtain Japanese yen in advance, overtaking the risk of Japanese currency to rise in the future. Therefore, Forex become crucial to run companies with many subsidiaries and suppliers all around the world. Well, these are the main players within the forex market, and because it has become so advanced, now is a chance for all to the retail investor to take their chance and get some earning the same way those big players do every day. I really hope you enjoy the content of this video today, and I will see you next week for the next topic. I wish you all a happy day trading. Bye bye.
Well guys, again, if you like the content of this video and if you think this video would have a great impact on why you should trade the forex market every day, please do not hesitate. Come visit us, press subscribe button, come and visit us on our YouTube channel, our social media, and please enjoy your trades every day. Bye bye.